Welcome to this week's Veterinary Ledger. I am going to apologize in advance. It's me and Jared again, right? Which you might be a little tired of just hearing from us, but this big new beautiful tax bill passed, and I feel like we should talk about it. So I am going to do my best to play dumb. It might be hard. See if it's convincing. And we're going to talk about what this means for veterinary practices. Hopefully, Jared will be the brains of this operation and explain things in a way that we can understand. So, Jared, what do we need? I thought that we were just calling it the big beautiful bill but that's its name, right?
There's a lot to this one. Some may think it's beautiful. Others may think, oh, this is a missed opportunity for some really good tax law change. I think Monday morning quarterbacking in a bit, I think it missed the mark on a few things I would have loved to see expanded upon for the practice owner. Some goods in here. But let's dive right in. I know you're about to jump on a flight. Where are you traveling to?
I am going to Cancun, right out of the frying pan into the fire. But yes, no offense, but I'm ready to go.
And I hope people can see, because if this is recorded, I mean, we get the same shirt. My logo looks backwards. I don't know if it's on my camera or not, but
we didn't plan on this either. We're just that lucky.
Now let's dive right in. Let's pick apart this bill here.
Tell me one or two. What are the biggest takeaways that we need to know right now?
Well, biggest takeaways, I think we have to go slow and go, maybe I'm going to give you 10, not 2. Let's start with what didn't change, right? So, and what bounced between business and personal. When we think of your personal tax filings, the question is, do I itemize my deductions, or do I take the standard deduction? What every single and or married joint return, their starting point for deductibilities. They left the standard deduction the same. They're indexing it every year for inflation. So our starting point for 2025 is you're a married couple, $30,000 in every year from there. It's going to be indexed for inflation. So within that, you always take the greater up, the standard deduction, which is the threshold amount, or the itemized deductions. And for most people, itemized deductions are the combination, the sum of charitable contributions, mortgage interest, and taxes. Taxes are combined as state taxes and real estate income taxes and real estate taxes. If the sum of those three numbers are greater than the standard deduction, you itemize your deductions. So just they didn't change the standard deduction. Within the itemized deduction, we've all heard about since 2018, the SALT cap, the state and local tax cap. So pre-2018, you used to be able to deduct 100% of real estate taxes and state income taxes. They capped that number in 2018 to $10,000. In the bill, they increased from 10 to 40 grand, but it's not an absolute. So the starting point is now a $40,000 cap on state and local taxes, but it actually comes down as your income comes up. So there is a phase out with a floor now at 10,000. So the worst case scenario is you're in the same spot you were 2024 and prior. Best case scenario is there's a few additional deductions that we're going to get for state and local taxes. Let's talk about some other things on the personal return that changed and didn't change. And I know you were eager to get into the qualified business income deduction, because that's a big one.
Tell me all about it.
Well, we're going to get there in a second, but that for mortgage interest deduction, if you buy a home, you're able to deduct the interest on the first $750K of principal. That remained unchanged. So they talked about doing something there. They didn't. Child tax credit. Who loves kids? Everyone, right? They bumped that up. You used to get a $2,000 credit per child. They increased that to $2,200 per child. Dependent care. Send your little one to daycare. You used to be able to deduct up to $5,000. They increased that to $7,500. So some of these things here, they're not necessarily needle movers, net positives for the individual. But again, I know you're sitting at the edge of your seat waiting to dive into the business stuff. So what questions do you have on business changes here, Megan?
I mean, we could start with what is QBI. No, but we can talk about what has changed with QBI.
All right. So for qualified business income deduction, again, these are all provisions that came into play in 2018. Essentially, simplest form, it's an additional 20% deduction you get on your profit. The issue in vet med is veterinary industry is considered a specified service trade or business. So there was always limitations as to what that deduction was truly going to yield you for benefit. Unfortunately here, there was talks to take the deduction from 20% up to 23%. That did not get passed. Would have loved to see that increase there. And again, they never asked my opinion. I was waiting for the call. but they kept the specified service trader business phase out in play. So unfortunately here, think of, a business that's not a specified service trader business, like say a manufacturing company. They're eligible for that full 20% deduction, regardless of, this calculations, but at any income level, right? The veterinary practice owner, we're still potentially eligible for the QBI deduction, but it's going to be subject to income phase outs and limitations. So I wish I had better news there. I thought we were going to get some enhancements to it, but it was not much there. If you're looking for a big win, a lot of practice owners have been paying the pass-through entity tax. That was essentially the business paying your state tax on your behalf. There was chatter to completely disallow that and get rid of it, get rid of that workaround, but that has survived. So the pass-through entity tax deduction is still a valuable planning tool for year-end planning to make sure that the business pays your state tax on your behalf to lower taxable income. But QBI, it's really going to be a strategic play of managing taxable income to get us into that tax bracket where you're not subject to the income phase out.
This all just feels a little like a washout at this point.
I wouldn't call it. That's not fair. I mean,
You take away a little, you give a little, this stays the same.
But the net positive, I don't think at the moment, I haven't said enough that would materially change kind of the year-end planning. A lot of this thing it's tax rates have stayed the same. Certain deductions and thresholds have stayed the same. The QBI deduction has ultimately stayed the same. It sounds like you want to talk about things that have changed in favor of the practice owner.
I think we all want to talk. No, I don't think it's a Megan personally thing. I think we need a win. We waited long enough.
All right. So let's talk about depreciation expense. That's probably one of your favorite items,
Spending
right?
money?
Spending money at year end, however, when you spend money, depreciation is just the cost recovery of that. You have two methods for accelerated depreciation. You can take what's called Section 179, or you can take bonus depreciation. Both now are going to yield you 100% deduction in the year of purchase. So bonus depreciation pre-signing on July 4th was down to a 40% acceleration. They bumped that back up to 100%. The critical piece of that, it's for assets placed in service after January 20th, 2025. So for some reason, those first 20 days of the calendar year, they didn't allow that bonus depreciation of 100%. So bonus depreciation is back to 100%. Section 179, they both play in the same lane. Section 179 and bonus, they both accomplish the same thing, meaning allowing 100% deduction in the year of purchase. What moves the needle on what do I pick? Do I pick bonus? Do I pick Section 179? Is usually dependent upon your state. Some states, the couple, they do not follow the IRS and they might disallow bonus depreciation. So in that case, your default obviously would be using Section 179. Again, federally would have been a moot point, would have get you the same answer. Section 179, especially if you're going through major renovation, major build, you're spending some money here, they increased the total eligible equipment purchases that are 179 eligible in 1 year up to $2.5 million. So that phase out where we've seen taxpayers previously when it was hovering around $1 million, $1.2 million, they hit the phase out. And the issue with the Section 179 phase out is once I hit that threshold, I can't take any more that year. So obviously the higher threshold, the better. They did bump that up. So two good wins to report here. Bonus depreciation is back to 100%. Section 179, that threshold has been increased. So the strategy of buying some equipment at year end is back in play, which kind of fell off a little bit here in the early part of the year.
Okay. For those of us that won't hit that $1 million shopping spree, remind us what the low end is that counts?
Oh, there's no low end, right? So as long as I buy an asset or any asset, so what is a fixed asset? Let's take it back to that. It's useful life greater than 1 year, and it costs more than $2,500. So if I buy a laptop that's $1,000, that's just office supplies. I don't have to depreciate that property. But if I buy a piece of medical equipment that costs 20 grand, well, that's a fixed asset now. So now I am either pick 179, which should be your default if you're profitable, should be the default is 179, with the backstop now being bonus depreciation gets you that accelerated tax deduction.
Got it.
You got it. You seem confident. You seem confident in
Yep.
some of these changes.
I'm ready to go and share the word with everyone else.
This might be the most listened to podcast now that we have just pure tax talk and we're just hammering home a tax bill. Like, I don't know,
It
maybe
is exciting.
this might pop the 10 views. We were hovering around that. This might get us to 10 now that we're there.
I think this is important. I think that everyone hears about these things and really has no idea what to do with them, right? Are we thumbs up? Do we like this? Or we don't like this? How do we feel about it? So I think it's important as a small business to revisit, like, this is good because, or this is neutral because. These are the things that are going to play out over the year.
If you're thinking of administrative burden, we all get to year end. We look at who we paid for vendors. You think 1099 independent contractors, the threshold there used to be, and it's just changed, but it's changed for the following year. So we're still under the current reporting threshold. But if I paid a vendor greater than $600, I was required at year end to produce and file a 1099 NEC. They bumped that threshold up to, do you know the answer here, Megan?
I do. It's
Oh,
$2,000.
she did. $2,000.
$2,000, which feels so much more manageable, right? Because $600 doesn't get you anywhere except for paperwork at the end of the year that no one wants to do. So I'm excited. This is one that I'm excited about because I understand it and I think it will make a difference to our day-to-days.
Regardless if I pay someone $100 or $2,500 next year, remember 2025, we're still under instead of making everything retroactive, they always kind of do half bag of a little bit of everything. But the 1099 filing requirement effective for next year, still make sure you get the W-9s. Any vendor you pay before they do work for you, get the W-9, see the 1099s even going to be required. Then thereafter, if you pay them greater than $2,000, January 31st of the subsequent year, make sure you issue the 1099 NEC to them.
I like it.
As you should.
Way more manageable.
What else we got on this beautiful bill here?
What do you think that practice owners should know? Like, there's so much, right? And there's so much that doesn't pertain to us, and there's a few things that do. Is there one thing, like, this is the thing that's going to impact us the most?
You would say that the bonus depreciation Section 179 enhancements certainly help. I think what this, at least for the next handful of years, instead it's going to be a lot more business as usual. Again, we didn't have the tax brackets change that we've seen in 2018 and in previous years to that. We don't have. There's a lot of headline stuff, the no tax on tips and all of this, but for the practice owner, I don't think there's enough that moves the needle, that drastically swings or changes what year end could look like. All the more reason to know the numbers that we're heading into tax planning season. You save money August through December. You don't save money in January of the subsequent year. That's too reactive. It's too reactionary. So the planning's done now to make sure you get to your landing spot that you want to be at. So I don't think there's one pearl, there's one takeaway based on what we're reading. And we're still trying, there's so many pages to this bill. We're trying to make sure we pull everything out of it. I think if anything, okay, we know the law going into it. It's not going to change my desire to buy or sell a practice. It's not going to drastically sway, do I move forward with this renovation or not? At least for the current administration, I know what the tax law looks like now. At least we have clarity. Who knows? Next administration comes in, 2029? Who knows what that tax law? You can't focus on that. You got to focus on what's in front of us for the next couple of years, right?
Yes, please.
So
What about, is there any changes to like LLCs or S corps? Is anybody saying like one's more beneficial than the other after this?
No, and they're both LLC taxed as an S corp, LLC taxed as a partnership. They're both what's called a pass-through entity. So ultimately, the individual is the one paying the tax there, and where there's no bracket changes or anything like that. Not a talking point. You had that though in 2018. The conversation was, do I take my pass-through entity, S corporation or partnership, and do I let to be taxed as a C corp? Because there was such sweeping tax reform and tax reduction at the C corp level. We advised against it. Doesn't change your tune. There's not much there. It's all noise and filler right now. So no, honestly, it's like, no, there's really nothing. There's nothing, no different lens to look at with your vehicle of choice. It's still default. We strongly encourage for the practice to be owned in either that LLC or PLLC. And then most times, not all times, but most times, that to make that S election to have the LLC or PLC taxed as an S corporation. So that still holds true even after reading this. A couple other things I don't want to, could be impactful to anyone listening here. Gifting, estate and gift tax planning, the estate, what I can gift over my lifetime, that did not get reduced. So that's great there. Currently, I can gift anyone, not employee, anyone up to 19,000 per person per year, indexed for inflation again. So that stays in play. And the one thing that you talk about gotchas, and we do see this sometimes, if you buy health insurance through the marketplace and you're getting those advanced premium tax credits, there was some sweeping changes to healthcare, health insurance within this bill. The advanced premium tax credits that you can receive, they were capped at what you would have to repay. So over the course of the year, if your income ended up being higher than planned, you used to have to pay back some, not all, some of that premium tax credit. Trying to be as simple as possible with this analysis, but starting in 2026, if your actual income exceeds your estimated income for the calculation, you'll be on the hook to repay the full excess amount. So the big takeaway to what I'm saying here, where are you getting your health insurance? If it's through the marketplace and you're taking advantage of the advanced premium tax credits, make sure you understand that your tax bill could be going up next year just because of that one change. So marketplace insurance purchasers, have the conversation, call attention to it. Hey, just so you know, I am buying my health insurance through the marketplace. Run the calculation of actual income to estimated income to see if you're about to owe a big tax bill come the subsequent April because of the advanced premium tax credits, the reductions you received on your monthly health insurance. I think that's going to catch a lot of people by surprise.
That would be a bummer.
That would be a bummer.
I don't want to farm on 179, but I think it's one of those things that we all kind of face where all your vendors are going to come to you now at the end of the year and be like, look at this. This is so much beneficial now. Like, when do we decide if it's good to spend money versus not? Like, how do we know taking a 179 credit is advisable?
I don't like that thought process is, hey, because it's available, do it. Well, no. First, ask yourself the question, what is my effective tax rate? Are you going to go and buy a piece of equipment in the middle tax bracket? So say I'm in a 22% bracket, right? Because I'm just starting out, I'm growing my practice, I'm in my early years. Profitability in the next couple of years is only going to be greater. Wouldn't it make sense to defer that acquisition of equipment until a later year when I'm in a higher effective tax rate? So before we just go out and spend money, know what your effective tax rate is. Because if you're not spending 40, if I'm in a blended effective rate fed and state of 40%, that $10,000 piece of equipment cost me $6,000 because my tax still comes down by the 4,000 or 40% of my purchase. If I'm in a 22% bracket, $2,200 off that tax bill. You got to weigh the cost benefit. Know your effective rate year after year. That should be your driver on when you spend money. When you're at a higher effective tax rate, and you can manage that. You can dictate what bracket you're in by spending money, by controlling the inflows and outflows towards the end of the year.
Who helps me with that? My vendors?
That's the part of the tax planning season. That's what we do here is strategically plan and know what your projected tax rate's going to be. So you have September, October, November, December to make sure, one, you stay in that effective tax rate, and to two, enhance everything else around you. So that's just tax planning. That's conversation. That's projecting out taxable income based on a year-to-date performance and having good, solid conversations with your advisors to make sure you're being strategic in that process.
Okay. So ask us first.
Ask us, ask away.
Ask Jared first. So this is like a slow and steady, right? We can expect this the next 3 years. This is what we got.
This is what we got. A lot of these were, permanent extensions. Anything that's a permanent extension with the tax code is always subject to change. So nothing is ever permanent because they can go and rip this out, in another subsequent bill. So at least, what's in front of us, we now know. We can now strategize and plan. I think parts of this bill at one point looked a little bit better. Parts, looked a little bit less. I'm not talking about the budget, the increase to the budget deficit or anything like that. I'm just focusing in on the veterinary practice owner, the impact to them. I think it's net neutral. I don't think we're going to see a material has changed. So because of that, now it's back to the drawing board, and now it's strategy for year end. All right, knowing what we know now, what do we need to do to maximize or minimize taxes as much as possible?
Okay, I'm okay with that, right? It's better than a thumbs down.
Better than a thumbs down. That's a sideways thumb. It's a sideways thumb. We're good. We know. At least we have clarity. At least we know now there's no rate changes or nothing like that could drastically change and force us to either yet. Because you saw that in 2018, right? Not to go back in time, but there was talk at one point about a drastic change to capital gains rates. And you had a lot of practices in 2020 time trying to jam through a sale of the practice, right? To make sure they locked it in at the preferential capital gains rate. Now, none of that ended up coming into play, but that drove some decisions. And in that time period, you now do not have that question on the table. Focus on what's in front of you.
I like it.
I
That's
like
good.
it. I know you got to hop on a flight here shortly to get some pina coladas and daiquiris. So
Swim up
um,
bars, yeah.
we'll be back as always the next week, bringing on another guest to the podcast and take it from there.
Y'all have a good week.